Welcome to episode 68 of the Cashflow Connections podcast. The topic for today is what you need to know about the 2018 tax bill. Today, we are joined by a leading real estate tax advisor to digest some of the most important updates to the tax law, which there actually are a significant amount of. And when it comes to real estate investors, people need to understand what's going on. So we're going to talk about some fascinating topics that maybe not sound so interesting, but actually have pretty significant implications. Cost segregation, the change in the operating loss deductions and the change in the pass-through deductions. We're also going to talk about different ways you can defer paying taxes, because that's the name of the game. Sometimes you're going to have to pay them no matter what, but if you can wait as long as possible, that's going to help you. So we're going to talk about the 1031 exchange, which a lot of you probably are very familiar with. We're also going to talk about something that you may not know as much about, which is the 721 exchange. There is a way that you can actually defer paying taxes on a gain that you own and roll that into a fund, which is actually available in our current investment opportunity. And many, many other ways to defer taxes. I'm just getting into some of these for the introduction. And of course, we're going to talk about the opportunity zones, which is one of the ways you can defer taxes. This is one of the most fascinating changes in the 2018 tax bill. I'm going to let our guests get into the details, but the point is you can actually defer paying massive gains, even in stocks, by investing in real estate, which is located in certain areas, which are called opportunity zones. This is one of the most significant changes in the tax bill because the details have not really been ironed out yet. People are only slowly starting to realize the benefits of how big of an impact this can actually have on the investment space as a whole and potentially the economy. But if you have large gains, which many of you do in your stock portfolio, this is a really, really interesting conversation. Now, during this discussion, you're going to find that our guest's knowledge of the topics is incredibly deep. You know I love getting into the details, but I hope this particular episode's not too dry. Really, the main key takeaway is very simple. If you are investing in syndications and you've got a self-directed retirement account and you own a business and your situation is getting more and more complicated, you absolutely need to get a specialist who specifically focuses on real estate investors. Having a really solid CPA becomes more and more important as you get into this world. And if you feel like you've outgrown your current CPA, 2019 might be the year you should start taking a look around and seeing some other options. Now, keep in mind, if you're going to consider making this move, don't be shocked by the sticker price, because with that change will come an increase in payment. But just remember, it's very likely that this will pay for itself many times over if your CPA is not on the level at what you're currently demanding. Just wanted to share that with you because we've all been there. We all have grown out our certain infrastructures. We all had to make changes, and that change does come with a cost. Now, of course, I have to give everyone a shout out that attended our first ever Intelligent Investors Real Estate Conference. This was honestly one of my favorite moments in my career. I have been able to spend the better part of a decade getting to know some pretty awesome people in the sector, and to be able to share that network with a lot of you, people all over the country, was pretty awesome. It was great to meet so many listeners of the show. I really can't thank you guys enough. Also, the content was awesome. Jack Ehrman from Post, he's been a guest on the show before, episode 35. Check it out. He was really great on the macroeconomics panel. The passive investment playbook panel got a lot of really positive reviews. Ryan Smith had a keynote, which was also very well received, unsurprisingly. He's a great presenter, is extremely knowledgeable. Chrissy, my fiance, and her company, Dynamo Events, they produced the event, and people were really just very happy with the level of detail and the organization. And so, overall, just couldn't be happier, 10 out of 10. If you didn't make it this time, I totally get it. It would have required a massive leap of faith to fly across the country to an event that had not established itself yet. But I'll tell you what, you don't have any excuse next time. If you talk to someone that went, they will tell you it was an all-time experience. We did a survey afterwards. We got a 97% vote of very good or excellent. So like an average of like 4.8 stars if you're talking about looking at a book on Amazon or something like that. Just overwhelmingly positive. Everyone had a great time. Everyone learned a ton, including me. It was really awesome. I can't wait to see what the testimonials say. We actually had a videographer team film the entire event, all of the sessions. We're going to put that online, and that's going to be available. Of course, there will be a cost associated with that because that camera crew was not cheap, but we just wanted to capture that moment. So again, if you guys made it out, absolutely awesome. If you didn't get to make it out this year, we are already planning for 2019. Trust me, it's going to be awesome. And you will certainly hear more about that once the date is solidified. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Sergio Salas, who is a partner at Armanino LLP. Sergio has more than 15 years of experience in public accounting. He focuses on serving the real estate industry, advising clients about their real estate transactions and deal structures, as well as their personal taxes. He's a member of the American Institute of Certified Public Accountants and the California Society of Certified Public Accountants. He received a bachelor's degree in accounting from the University of Notre Dame and a master's degree in business taxation from USC. And I know it's a bit shocking, but we actually haven't had a CPA on the show yet to discuss taxation. So Sergio, it's really an honor to have you on. Thanks again for coming on.
Hunter, thank you so much for having me. I'm looking forward to sharing some information with you and your listeners.
So one of the reasons that we've waited so long to discuss this, and one of the reasons that I thought you would be a great fit to discuss some of these topics, is you have an interesting position in the business. And I know that a lot of your business is really focused on servicing real estate clients and with varying degrees of complexity. So I wanted to give you an opportunity to tell us a little bit about your background and how your firm is positioned in the marketplace, particularly as it relates to real estate.
Yes. So just a little bit of my background. I've been practicing actually almost for 20 years now. And when I started, I was more of a corporate tax guy. That's really what I was focusing on, mergers and acquisitions, which for me at that point were very interesting and exciting until I ran into real estate, right? And when I started working on real estate and flow-through entities, and I saw the tremendous benefits, not only as a business investment, but the tax benefits that you can obtain, I completely switched. And for now over 13 years, that's been my primary focus, and that's what I specialize in. Armanino itself, we have deep roots in real estate going back to, I would say, almost 50 years. We work in key segments throughout the industry, from owners, operators, and developers to contractors, to real estate funds like syndicators and mortgage pools. We have experts who specialize in real estate entities as well as individual investors. We can help out, like you mentioned, with tax planning for our clients, helping with the capital gain planning, taking advantage of depreciation rules, trust and estate planning, wealth transfer, et cetera. So we have a significant amount of expertise in this area.
Awesome. And then we're going to get into the details of a lot of those terminology and vocabulary words that you just mentioned. But you frequently hear, starting from the big picture, you frequently hear people talk about, the tax benefits of investing in real estate. You mentioned depreciation, but what are some of the ones that really come to mind when you say, wow, this is a really favorable asset class because of the way that the tax policy is written in the U.S.?
Yeah, so this is actually the thing that really caught my attention when I started working in real estate. My clients, I started noticing that many of them were doing financially very well. The cash flow purposes, they were cash flowing year after year, generating a tremendous amount of wealth. But at the same time, they were paying very little or no tax. And I said, wow, what other type of investment can give you that advantage where you are generating a tremendous amount of wealth, cash flowing on an annual basis, but not paying tax? And that's what you're talking about, the benefit of depreciation. Along with that, you can, depending on, if you hold real estate your entire life, upon your deathbed, you can transfer that asset to your heirs tax-free. Well, I shouldn't say tax-free. It could be a state tax, but they get a step up in basis and then they get to take depreciation all over again. So it's a tremendous benefit, but that's only one of the benefits, in real estate. Another one is, as I mentioned earlier, is receiving cash flow, the tax-deferred cash flow. For generally, when you purchase real estate, a property most likely will be cash flowing, but because of depreciation, there's no tax to pay. Generally, for tax purposes, there's a tax loss. So there's no tax that is being paid. So that's another really good benefit. Under the new law that passed late last year, depreciation even got better for real estate owners. There's this concept called bonus depreciation, where you can take what's considered personal assets, assets that have a 5, 7, 15-year life. And you can take 100% bonus depreciation, or you can write it off entirely in year one. The asset doesn't have to be new. It just has to be new to you. And you can write it off completely in year one. What else? Losses from real estate. Your investors may be familiar with the passive loss rules, which basically means that if you're not actively engaged in the business, the loss is considered passive. For real estate, especially in real estate, is considered a passive per se, and that those passive losses can offset passive income from other businesses. any losses that are not used are carried forward indefinitely, and they can offset future passive gains, passive income from real estate activities or other passive businesses.
Yeah, go ahead.
I was just going to mention real estate professionals. That's another tremendous benefit. If you qualify as a real estate professional, these losses are not considered passive. They're considered a business loss. And that loss can offset any other type of income, whether you have wages, investment income, capital gains, etc. So there's a significant amount of benefits in real estate.
Yeah, you touched on a lot of that. And I think that the changes, which is definitely something I want to get into with you, they're pretty significant. You mentioned being able to depreciate an entire 15-year, 7-year depreciation schedule in the first year. That can be pretty remarkable for people that are in high incomes, or let's say, for example, that you're about to experience a really large capital gain and you have one of these assets that has a short depreciation schedule. You can take all the depreciation over 1 year. Just to clarify, before we even jump into all of those details there, just so anyone that doesn't know, could you explain briefly what depreciation is and how that can impact, the tax deferral status of a lot of real estate investments?
Sure. So depreciation is basically the government allows you to write off your asset over what they call a depreciable life. The personal property, is considered 5-7-year property, and that includes equipment, furniture and fixtures. 15-year properties, land improvements, lighting fixtures, etc. Generally, it's considered personal property, and that you can depreciate over 5, 7, 15 years. These assets qualify under the new law in what's called a bonus depreciation. And the remarkable thing about the new law is that you're allowed to fully depreciate these assets in year one, even if these assets are not new. Prior to the new law, these assets had to be not just new to you, but they had to be newly used, never been used before. And so now how the new law impacts real estate investors is, let's say you go buy in an apartment building that was built in the 80s, and you do a cost segregation study, you split the asset between 5-year asset, 7-year asset, 15-year, 27-year life. And all of a sudden, all this 5, 7, 15-year assets, you get to write them off all in year one. And that's the beauty of depreciation and how it can really help you shelter a lot of your income.
Yeah, so for those that aren't familiar with the cost segregation is interesting because when you buy a property, typically you'll see longer depreciation schedules than 5, 7, and 15. But what Sergio is kind of outlining is that you can do a study which analyzes that there are certain parts of your property that have shorter depreciation schedules. And just to clarify, the shorter depreciation, the more significant the write-off is every single year. So let's say, for example, you had a property that was being depreciated over 29 years. Well, that's about 3% of the property on an annualized basis, just to keep things simple as possible. Now, if you have a shorter depreciation schedule, it's more significant, meaning that loss is more and more of a write-off from a tax basis. But with this change, you now can move all of that to year one, meaning that you can keep more of your money sooner and therefore, use that money to reinvest. What are you seeing as being, just give us an idea in terms of 5, 7, and 15, what are typically property types that are 5-year, 7-year, and 15 that you can own?
Yeah, so if we're talking about real estate in particular, 5, 7, 15-year property includes, generally for a building, the structural framework of the building, which I quote unquote call the bones of the building. That's the 27.5 or 39-year life, depending if you're talking about residential or non-residential. But other assets, including, say if you own an apartment building and when you buy it, it includes the appliances, it includes light fixtures, it includes the landscaping, obviously the parking lot, all these things, assets that are not part of the structural framework of the building are these 5, 7-year, 15-year assets. And when you hire a firm to do a cost segregation study, they'll break down the building into these different asset classes. And you're able to, and this actually is allowed by the IRS, you're able to take this breakdown of the building into your depreciation schedule and take the accelerated depreciation.
Okay, got it. And from your perspective, what are some of the asset classes that really stand out as having a more significant piece of them or a more higher percentage of them being depreciated over 5, 7, 15 years?
Like I mentioned, it was, equipment, furniture and fixtures, appliances. If you're in an apartment building, the carpet can qualify. Not in the carpet in the hallways in the lobby, but the actual carpet in one of the apartment units. If you have a parking lot, that could be considered a land improvement. That's a 15-year property.
Right. Yeah, that makes sense. And so I guess really what I was asking there is, are there certain asset classes within the real estate sector? So, for example, hotels versus self-storage or mobile home parks versus multifamily that you say, because of the way that these are particularly structured, that these are extremely advantageous because that more percentage of your purchase price is attributed to those shorter year depreciation schedules.
Got it. Yes. So generally what I've seen is in, like you mentioned, hotels, there's a tremendous amount of personal assets or these 5, 7, 15-year assets that generate a lot of depreciation. Same thing with apartment buildings, special care facilities or nursing homes. There's a lot of equipment that could be considered 5, 7-year property. The ones that you don't see as much of a tax benefit is in commercial. If you have like a big box retail center, it's really just a big box. There's not really much you can break down. But the other ones that I mentioned are really the ones that you can get a tremendous amount of benefit and depreciation from.
Okay, that makes sense. And then there's been some changes in the laws. You mentioned a little bit in some of them earlier. Do you see any particular asset classes that are now significantly more advantageous from a tax perspective, given these changes in the laws and the way that depreciation can be captured?
Yes. Well, first of all, one of the asset classes that's going to benefit tremendously are whether it's retail or residential or commercial properties. Before, you can take advantage of this bonus depreciation, the full write-off in year one for the personal property. And now you can. So if you're just buying let's say, for instance, an apartment building and you plan to do nothing, you just want to buy it and operate it, keep operations going the way they're going. Even if you do nothing, you can still get a breakdown of the assets, cost segregation, and be able to take advantage of the depreciation from year one. Now, if you decide you're going into an investment it's a value add where you're going to spend a significant amount of money doing improvements. All these additional improvements could potentially also qualify to be written off in year one. And let me give you an example. One of my clients purchased a property and they were fortunate. They actually purchased the property they closed escrow a few days after the new law passed. So they qualified under this new law and they bought it it was an apartment building for $90 million. And they did a cost segregation study. And because of the cost seg, they were able to write off just on depreciation only $25 million, which is a significant write-off.
Right. Wow. That is remarkable. And so they did that. Did they take all of it then in year one?
Yes. And so the advantage is they took all that write-off in year one, which generated a loss on this individual's tax return, which is now he's carrying forward. He's a real estate professional, so he's able to carry it forward. It sheltered all his other income in year one, and he's carrying forward the remaining loss to year two the following year.
Okay, so that's actually a really important point there. So, most people don't need a $25 million loss on 1 year. Now, you can imagine a situation where you have a very large company, you sold a bunch of assets that had a significant gain, and therefore you're looking around trying to offset some of that gain, buy this property and take as much depreciation as year one. But really the goal there is not to just take as much depreciation as you possibly can. The goal is to balance it out so that you can offset some of that gain. Would that be kind of an accurate representation of what you just said?
Absolutely. I mean, it's and the great thing, this depreciation and these losses really benefit real estate professionals because it's considered a business loss or an operating loss, and it can offset any other type of income, whether it's like I mentioned, wages, interest, dividends, capital gains. But if you are just a normal investor, these losses, the only disadvantage of this is these losses generally can only offset passive income. However, due to some income thresholds, you may qualify to be able to take up to a $25,000 loss that can offset other types of income. For example, if I have wages of $100,000 and I'm actively participating in my rental activity. I'm not a real estate professional, but I do actively participate. And let's say I have losses of $20,000 from my rental activities. I can use those $20,000 of losses to offset some of that tax from my wages. Now, if there's an income limitation, but if you do fall below that income limitation, it's another good benefit to be able to use these losses from real estate.
Yeah, that's a good point. And actually, just for the listeners so they're familiar, what is the income limitation, let's say in 2017, in terms of writing off losses like that?
It's $100,000 adjusted gross income. So for married filing jointly. So if you're filing a joint return and your adjusted gross income is less than $100,000, you should be able to use that $25,000 loss limitation.
Got it. So a lot of the listeners of this show are investors in a lot of syndications. And when it comes to depreciation, there's a big spectrum out there as far as how depreciation is passed through to investors. So I want to get your perspective, given that you've seen a lot of these deals and this is one of your focuses. What do you typically see in terms of how depreciation is passed through to investors? Do you typically see that it is 100% passed through? Is it based on the split above the preferred return or something like that? I mean, what is the spectrum of what your clients are typically using?
Well, this is a little more of a tax geek kind of thing, but basically the way losses are allocated is they're allocated to those who have something at risk of losing. So for example, if I invested $100,000 into a deal, I'm at risk of losing $100,000, right? I mean, I have that risk. And so I'm able to be allocated $100,000 of losses. So generally in syndications, the investors are the ones that are putting in the biggest chunk of the money, right? Whether it's 90% and the promoter puts 10% or 95% and the promoter puts 5%. So generally the large majority of these losses are allocated to investors in a syndication. I have seen situations where the syndicator is more at risk of loss because they're guaranteeing loans or the way they structure their waterfall. And so at that point, they may get a bigger chunk of the depreciation. But generally, you see these depreciation benefits going to the investors.
Yeah, that's a fair point and something I hadn't really considered. But yeah, it's really about the loss and including that most of the deals that we invest in and underwrite, the sponsors are the ones that are going to be personally guaranteeing the loans. That also kind of balances that out. I think it's fair to consider those things when looking at that. Really, the goal should be to, again, achieve that net non-tax exposure. It's not to have a crazy write-off for your investors every single year. It's really to just be able so that their tax account is zero for their particular investment. And this is possible in most of the types of investments that you'll typically invest in so that all of the cash flow is deferred. Now, when you sell a property, there is a tax typically, and there's a recapture tax for kind of paying for the fact that you didn't have to pay all those years. But maybe we'll talk about that in a minute. I just want to talk about some of the things that have also changed because this is one of the topics that people need to be very mindful of. There has been some changes when it comes through the new pass-through deduction. I was wondering if you could kind of explain what that means and how this might impact someone's tax strategy.
Yes. So under the code, it's called Section 199A. So you may hear refer to it that way, or the pass-through deduction, or the 20% deduction. I've heard it referred to many different ways. But basically what it does is if you have a qualified investment or a business, it has to be a trade or business, but if you have a qualifying business and you get a K1, and it could be, you could get a K1 either from a partnership, an S corporation, or if you're a sole proprietor. But if you get this income from this qualifying business, you potentially are able to exclude 20% of that income from being taxable. Now, there's a lot of rules and thresholds that can start applying depending on your income thresholds. But the general rule is if you're married filing jointly and your income is less than $315,000 or $157,500 for all others that are not married filing jointly, then you can take a deduction that is equal to the lesser of 20% of their qualified business income or 20% of the excess of their taxable income over capital gain. So the IRS will let you take 20% of whatever your qualified business income is as a deduction, or if your taxable income, not including capital gains, is a lower amount, you'll take 20% of that number.
Okay. And what was this previously? Is this a completely new deduction that did not exist at all?
Yes. So a couple of things. First of all, this is a federal law only, so it does not apply to states. So when your investors are considering or looking at what their taxes are going to be or discussing it with their tax professionals, they have to realize that this is only a federal tax benefit. It doesn't apply to the state. But yeah, it's a completely new law. Prior to this law, there used to be another law it was a Section 199, and it was known as the Domestic Production Activities Deduction. But that's completely gone away, and it was replaced by this one, and it's a completely new law. It has a lot of complexities, a lot of rules. As a matter of fact, just recently, some proposed regulations were issued, and it was over 160 pages of regulations, just to give you an idea of the complexity.
Unbelievable. And there's a couple more that I want to talk about, which are similarly complicated, and I still haven't completely wrapped my head around. But one of them is the net operating loss deduction. And this is something specifically as it relates to real estate. Could you kind of explain what this means and how it may impact a typical real estate investor?
Yes. Okay. So just to give you a brief background, net operating losses are generally losses from operating businesses. And for real estate professionals, losses from real estate activities can be considered these operating losses. And if, let's say in 2017, your losses from these operating businesses or from real estate are greater than your income, you have what's called a net operating loss. And in prior law, you were able to carry back that loss 2 years and carry it forward 20 years. Under the current law, you can no longer carry that loss back. You can only carry it forward. Now, there's two things now that are changing with the losses. Number one, now you have what's called an excess business loss. So let me give you an example. Let's assume you're a real estate professional and you have losses of, let's say, $1 million. And you have income, other income, from wages and interest, dividends, retirement income, whatever it is, just other types of income. Let's say it's $800,000 of income, right? In the past, you were able to completely use that $1 million of loss and completely offset the $800,000 of income. Mm-hmm. And that excess, you can carry it forward. Under the new law, you can only offset up to $500,000 of that income. So now, even though you have $1 million loss, you can only use $500,000 towards that $800,000 of income. So now you are going to pay tax in the current year. The remaining loss that you're not able to use in the current year, you carry it forward to the next year. So that's one of the disadvantages of the new law. Another disadvantage is that the losses, the net operating losses that you're carrying forward, starting for losses that were generated in 2018, they can only offset up to 80% of the income in the following year. So you are no longer able to offset 100% of the income in the following year with these losses. They can only offset 80%.
Okay, that is actually pretty remarkable and does make a big difference. So just to clarify, the key here is that you can offset future years, but you're going to be paying taxes in this year. If you have that situation where you have $1 million loss and you have $800,000 of income, in that situation previously, you would be net even, or I'm not sure what the correct terminology is there, but there would be no tax exposure is the whole point. Now, it sounds like you would have a tax exposure. Now, you can move the remaining loss. In this instance, it was $500,000 loss that you estimated, and then you can remove that $500,000 for future years in which you could offset future income. But the challenge is you can't offset 100% of it. You can only offset 80% of it. Is that correct there?
Right. 80% of the income in the following year.
So, in the following year.
Yeah.
And then you can then carry over any future loss to another year. But the point is you're basically paying tax as opposed to not paying tax. The whole point is that you want to not pay tax 100% now. So, because you could just the whole goal here is to try to defer as far as you can. And there's a lot of ways to do that. Real estate's really good at that, but this is one of the ways that the change made it not quite as favorable. Is there anything else that you wanted to add to that particular part? Because that's a pretty fascinating piece of this.
Yeah, I mean, and just going back to what I mentioned in the beginning, one of the benefits of real estate is I've had clients, that have had generate tremendous amount of cash flow and have not paid tax for years or very little tax. Well, that's going to change, right? Based on this example, because now they can only offset so much of their other income with these real estate losses. And so then now they're going to, taxpayers that have not paid any tax or very little tax for years are now going to start paying tax.
Right. That's an important distinction. So the real estate still is basically net balanced or net even. The point is you can't take the real estate losses and bring them into your W-2 as much to the same extent. Is that kind of a fair estimation there? I keep asking because I want to make sure that I'm not saying something incorrect.
Oh, yeah, that's correct.
Okay, perfect. Speaking of deferring and trying to not pay taxes for as long as possible, probably the most advantageous and long-standing way to defer paying gains is through this 1031 exchange. This is something that many listeners have probably heard of before, but just could you briefly explain what a 1031 exchange is and how it's utilized to defer paying taxes on gains?
Sure. So whenever a taxpayer sells real estate and there's going to be likely a gain, the taxpayer generally has to pay tax on the gain at the time of the sale. Section 1031, and the reason it's called 1031 exchanges is because it's Section 1031 of the Internal Revenue Code, but that code section provides an exception that allows taxpayers to postpone paying of the tax. Now, it's not a tax elimination, it's a tax deferral, but you have to be able to reinvest the proceeds from the sale of the property into what's called like-kind property or similar property. Under the new law, only real estate is allowed now to be qualifies now under 1031 rules. Other business property that used to qualify no longer qualifies. For instance, personal property no longer qualifies for 1031 exchanges. Only real property, which is like the building and the land.
Okay. I didn't even know that was possible with businesses. I think that remembering it now, something comes to mind, but there's a lot of challenges with the 1031, even in real estate. Like I said, a lot of our investors invest via syndications. And so you really can't complete a 1031 unless you do a lot of very specific things up front. Do you have clients that have basically invested in syndications that have implemented a 1031? And if so, how are they able to do that?
Syndications things get a little difficult because now if you think about it, in a syndication, you could have a couple investors, or it could be 10, 20, 30, 50, 100 investors. Mm-hmm. And generally the taxpayer that owns the property is not really the individual investors, right? It's an entity. Generally, it's a partnership or an LLC. And so the party that has to enter into an exchange has to be the partnership. That's the entity that owns the property, and that's the one that enters into the exchange. It's the one that's going to sell the property and has to enter the exchange. Unfortunately for investors, they cannot exchange their partnership interest for other partnership interests. That's not considered like-kind property, so they're not able to do it. And so now what makes it difficult for syndications is that some investors may, if the promoter or the syndicator finds a great property that they want to go ahead and sell the property that they currently own and exchange into this other new greater property, they can't just do it on their own, right? They have to get approval from their investors. And a lot of the time, especially in syndications, is you may have some investors that may not want to enter into the exchange. They may just want to cash out, or maybe they want to not go into the property. They may want to do something else. And so that makes it challenging. Now, there are some tax planning opportunities that can help mitigate this problem, but your investors really should talk to their tax accountants to really do some planning up front. And it's something that cannot be done right away. If the property is going to be sold in a month, you should have been doing this planning months ago, right? You can't do it the month before it the exchange is going to happen or the sale is going to happen. For the syndicator, there's various things that they have to worry about, right? I mean, if they're going to enter into the exchange, there's rules in a 1031 exchange that they have to follow. For instance, they have to, once they sell the property, they have 45 days to identify a replacement property. And then they have 180 days from the date of the sale to exchange or to purchase the replacement property. They also have to have a lender in line. So there's quite a few things that need to be done up front before an exchange is even considered.
Well, I mean, part of that is that it should probably be structured in a certain way before the property is even purchased up front. Because there's a lot of people that bought properties in 2010 that now are thinking, wow, it'd be really great if I could 1031 exchange this property that I've invested in with 100 investors. And part of the problem is the entirety, it's my understanding at least, the entirety of that partnership has to come along for the ride. Meaning that if you have an investor, let's say you have 100 investors and 3 of them do not want to go for it, they want to experience a liquidity event, they need to be involved. Like the partnership cannot change, meaning that yes, you could potentially buy out those 3 investors, but you would have to start doing that, to your point. Now, one of the strategies that I've seen people use is using the DSTs, the Delaware Statutory Trust, in order to implement this. I have not personally invested in a deal that's done this, but I was wondering if you could explain why it is that the DSTs are used to facilitate this or to help facilitate this, and if you think this is advisable, and any thoughts would be appreciated.
Well, I haven't seen any syndications using a Delaware Statutory Trust. Basically, a Delaware Statutory Trust is treated similar to a tenants in common, where basically a Delaware Statutory Trust is a separate legal entity, and it's created under the laws of Delaware, and each owner has what's considered a beneficial interest in the trust for federal income tax purposes, but it's treated as owning an undivided fractional interest in the property, similar to a tenants in common. And so what your investors can do is they can take their property and either sell it, they start a 1031 transaction, they can sell it, and then use the proceeds and invest it in a Delaware Statutory Trust, or they can transfer the property to a Delaware Statutory Trust and be able to implement this. Now, I haven't seen it in a syndication. Similar to a tenants in common, the limitation with a tenants in common is you can only have maximum, I believe it's 35 owners that are going to have fractional interest in the property, and that they basically have direct ownership in the property, and then they can each either sell their property or exchange their property into, whatever they want to, separate properties if they want to go their separate ways, or they can exchange into one property with all the other investors. But I haven't seen it in a syndication.
Okay, interesting. So I want to kind of clarify, because again, I haven't done this, so this is going to be new for me as well. So the tenants in common allows for more flexibility, but you have to hold the entity has to be purchased in a tenants in common. And then this allows the flexibility for some investors can 1031 exchange into a new tenants in common, and that's really why it's held like that. It's not a partnership in that instance. It's each individual investor themselves.
That's correct. Yes.
And would you be able to hold the ownership of that tenants in common in an LLC, or does that tenants in common need to be owned by a person?
No, you can. Again, whether it's an individual owning it, and to answer your question, if it's a single member LLC, yeah, you can own it. Or it could be, let's say you and I are partners in a partnership, and our partnership holds a tenant in common interest with other investors. So yeah, you don't have to own it directly. It's just basically whomever the owner is of that tenant in common interest is the one that has to enter into the exchange.
Okay. And so if this is the case, why is there any challenges that prohibit people from doing this? The reason I'm asking is I've invested in many syndications, but I haven't seen this strategy be utilized much.
Well, here's a difficulty. If let's say you have a partnership with 10 partners, okay, just to make it a little, or 20 partners, and you want to enter into an exchange, but let's say 2 of those partners don't want to. They say, you know what, it's been great, but I just want to cash out and I want to kind of go on my merry way, and that's fine. Now, one of the potential moves they can do, or tax planning things they could do, is the partnership can distribute the property to the investors, and then each one of those 20 investors now has a fractional ownership interest in the property. Now, the difficulty here is, number one, you have to change title, right? Now, you're changing title from owning the property, which only has one owner, currently was the partnership, and now you can have 20 different partners. You have to go through that. Number two is the lender has to be okay with it. The lender has to be okay with the transfer. And that becomes challenging. A lot of the times lenders don't want to do that, or it's very time consuming and it can get expensive. But if you're already in a tenants in common investment where it's you and 5 other investors that just happen to enter into the transaction as a tenants in common, then it's a lot easier, because now if after a few years of owning the real estate, let's say 5-10 years, when the property's sold, everyone can go their separate ways. They can exchange into other properties, or they can just cash out, or they can invest in this and put their money in a Delaware statutory trust. But it really depends on who the owner is of the property. There are some planning opportunities to be able to help investors that are in a partnership that want to get cashed out. But again, like I mentioned, this is some planning that has to be done months ahead of time and not right when the exchange is going to happen.
Right. It's something that not only ahead of time, but again, I think it should be considered, upon the purchase of the property, which is why I'm interested to see more and more of these pop up. I know that there are opportunities to invest in these deals, but again, I haven't personally been involved in them. Moving on to something else, again, that I haven't been personally involved in, but I'm very interested in. Now, we typically use and frequently use funds that have multiple properties in them as our preferred investment vehicle. I'm a huge proponent of the fund model. I think that the diversification allows for predictability of outcome. It really helps me sleep at night as an investor. It helps me sleep at night much more, even as a business owner, because our investors are going to have a much more predictable experience. But again, you do have the challenge with the lack of the 1031s typically. But there is another strategy that I haven't done, but I know it exists, which is called a 721 exchange, or an UPREIT. I was wondering if you could explain what this strategy is and how frequently you see people utilizing this.
Okay, so just like the other sections, 1031, et cetera, the 721 really refers to a section in the code, and this section in the code refers to the allowance of, or that no gain or no loss is recognized to a partnership or any of its partners when a contribution of property is made in exchange for a partnership interest. So for instance, if I own an apartment building and there's a partnership over there that owns other apartment buildings, and I say, hey, I want to be able to diversify my investment, I can go in and contribute. Generally, I should be able to contribute my property to this partnership in exchange for a partnership interest tax-free. And that's different from corporations. It's a lot more difficult to do it with corporations, and that's a different code section. But if you have a property that has debt and you want to contribute it to a corporation, it's a lot more difficult to do it tax-free. So that's what the 721 refers to. But the reason the structure was set up is a REIT is generally, it's a corporation. And for tax purposes, that's the way it's treated. So if I own a property, I can't, and I want to be part of that REIT, I can't contribute my property to the REIT, like I mentioned, because it's a corporation, and there's other legal or tax limitations that prevent me from doing this. But this UPREIT that's created, and basically an UPREIT stands for Umbrella Partnership Real Estate Investment Trust. So a REIT is a real estate investment trust, and UPREIT is an Umbrella Partnership Real Estate Investment Trust. And it's basically an entity that REITs use to let property owners contribute their real estate in exchange for a partnership interest, or what they call an operating partnership unit. And then at some point, you can convert your operating units to REIT shares. But it's another way to be able to do almost like a 1031 exchange without doing a 1031 exchange. And so, for example, let's say I own a property, an apartment building, And I've been, very involved with it for years, and I've owned it. And now it's time for me to retire. And I say, you know what? I love real estate. I want to continue owning real estate, but I don't want to be managing the property. I don't want to be as involved. I want to be more of an investor, right? So what an UPREIT gives me an opportunity is I can contribute my property to this UPREIT in exchange for a partnership interest. And generally these UPREITs are partnerships, and they own various amounts of others real estate properties. So now what I own is an interest in the partnership that owns a lot of different real estate, not just my property, but all the other properties. And so the advantages is now there's a lot more diversification. Some of the things that investors have to look out for is these real properties can be located all over the country, right? So when you get your K1, you might have to report taxes to a bunch of different states as opposed to just to the state where you originally owned your property. But it's another way to be able to, quote unquote, transfer your property tax-free and be able to diversify your investment.
Yeah, and I appreciate you going through that. And it's interesting because like the best way that I would explain it, just to give an example. So, you said you had this property that you're looking for to retire. So we had an investor that had a very, very low basis on a property in New York. And I think they had close to $1 million gain on this property. And we had the opportunity to allow them to essentially 721 their property into our fund. And they were able to do this without tax exposure. Now, there is some differences in the sense that you cannot then 721 those shares later down the road. You have to accept that the fund, the one in our case, the fund that we currently are managing, the gains that are going to be issued from that fund, you're going to have to pay. And the properties will be sold, and you cannot then transfer those shares into another. You can't do it twice, basically. But it does help you, even if it's for another 10 years, depending on what your goals are, it can make a big difference. So, before we go, though, we have to discuss something that has been a really, really hot topic of conversation in the real estate sector, which is the opportunity zones. This is a very new thing. A lot of people, no one really knows the details of it yet because it hasn't been completely finalized. But what are your thoughts, or I guess give us an explanation of what the opportunity zones are and what your thoughts are on how significant this change is or may be?
Yeah. So again, this was another thing that was new with the tax law that passed last year. And it actually was under the radar for months. And it wasn't really until maybe about 6 months ago that I started having more and more of my clients asking me about it, especially the developers. And basically what this is, an opportunity zone is basically an economically distressed community, and they're all over the country, where investors can invest in these opportunity zones and get certain tax benefits. Now, in order to, when an investor invests in an opportunity zone, they can either do it directly or they can invest in a qualified opportunity fund, which is basically an investment vehicle that has at least 90% of its fund assets invested in opportunity zones. Now, these opportunity zones are, as I mentioned, localities all over the country. As of June of this year, I believe about 8,700 communities were designated as opportunity zones. And the benefits to investors, and this is, the big thing that my clients really look towards and why they want to be going to these opportunity zones. Again, number one, it's a federal benefit, so it doesn't apply for states. Generally, states are not haven't conformed to this law. But if you invest in a qualified opportunity fund, you can defer the tax on capital gains until December 31st, 2026. So if I have, let's say, and it could be a capital gain on anything, it doesn't have to be real estate. It could be, I sold Microsoft stock or Apple stock or just some other type of stock and I have a big gain, I can invest this gain into an opportunity zone fund. And I can defer having to pay tax on the gain until December 31st, 2026. If I hold that investment for at least 5 years, 10% of that gain is eliminated. I get basically a 10% step up in basis. So when I eventually recognize that gain, I would only have to recognize 90% of the gain. If I hold the investment for 7 years, instead of getting a 10% step up, I get a 15% step up. So if I were to recognize the gain later, I only pay tax on 85%. Now, the thing that sometimes makes it a little bit difficult for my clients is that investors are only able to defer the tax until December 31st, 2026, which means that at that point, they're going to have to pay the tax on the remaining balance. However, if investors pay that tax, but keep holding the investment until they hold the investment for more than 10 years, any increase in value for the property after that point is completely tax-free.
I didn't even know that.
Yeah.
Yeah, I didn't even know that. That is remarkable. Do you think that this is going to make a big impact on these markets? I mean, you mentioned that there's so many, so I can't imagine it's not extremely focused, but do you see this as being, a potential way that Like, do you think people are going to be taking advantage of this? I mean, this is just pretty significant in terms of what's available out there.
Yes. And the reason this law was created is really to be able to pump in a lot of money and investment into these distressed areas, right, throughout the country. And it's not really just buying real estate and qualifying. It's basically, and let's say, for instance, in our world, in real estate, you just buying real estate in an opportunity zone does not qualify you for this benefit. You have to, quote unquote, substantially improve the property to be able to qualify this benefit. And what that means, like I said, for developers, this is a great benefit because if they buy a property and then they're going to go in and build an apartment building or a shopping center or something, that makes the fund, qualifies the fund as an opportunity zone property. And, they can qualify for this investments. Basically, what it means is if I buy a property and let's say I buy it for $1 million and 400,000 is land, 600,000 is building. In order for me to qualify as a qualified opportunity zone property, I have to reinvest another 600,000 into this fund and improvements in order for me to qualify. Now, this is great for developers and this is great for communities because they're trying to pump in money to be able to develop these communities that have been distressed over the years.
Pretty remarkable. We've covered a ton of ground. I mean, I don't know that I've ever heard an interview with such a significant amount of content when it comes to just different ways you can defer. It's all pretty incredible. Is there anything else that you wanted to touch on that are some changes that are noteworthy that investors should be aware of? We don't have to go through the details of each, but just something that they could Google on their own to be aware of.
Yeah, I mean, one of the things, and again, this is not a new law, but I wanted to mention it to your investors because a lot of the times what I see with my clients is they invest in certain deals and they get a K1 with a loss. They automatically assume that they're able to use that loss or offset that loss with their income on their return. And what they have to realize is that there's really three things that they have to be aware of. Number one is, do they have basis to be able to use that loss? And number two, whether it's at risk basis, whether they're at personal risk of losing money. And then number three, whether that loss is passive or non-passive. And that's very significant because I see it over and over again when my clients receive a K1 with a loss and they think, wow, I'm not going to owe tax this year because I had this tremendous loss from this K1, until I tell them, I'm sorry, but you're not an active investor, you're a passive investor, so you're not able to use this loss. So they should keep that in mind. And another thing that's going to be a big benefit is for your clients that own a lot of assets and they want to be able to transfer some of those assets to their heirs tax-free. The gift and estate tax exemption doubled. It used to be $5 million per individual. Now that increased to $10 million. It's indexed for inflation. So in 2018, it was about $11.2 million. So what that means is that each individual can potentially transfer estate tax-free to their heirs up to $11.2 million of assets, which with significant tax planning, that could add up to quite a bit of real estate that can be transferred. The Section 179 deduction, which we haven't talked about, it's similar to bonus depreciation, where in the sense that you can take a full write-off in year one up to $1 million. That is also, I believe the threshold prior to this was $250,000. Now it's $1 million. What else? Let me think. There's one thing that could be bad news for investors in real estate is this new limitation on interest expense. Any net interest expense that's in excess of 30% of a business taxable income is disallowed. So if I have a business, for instance, in real estate, and I have a mortgage, if my interest expense is greater than 30% of my taxable income, I could be limited in how much I can deduct of that interest. Now, this is not really doesn't really apply to a lot of my clients because there's an exception for if their annual gross receipts over a 3-year period does not exceed $25 million, this interest expense limitation doesn't apply. But it could apply to, for instance, if you own a big hotel that generates $30-40 million of revenue per year, that can affect them. And so we talked about the NOLs, which I think are gonna. The good thing is you can carry them forward indefinitely, but the bad thing, you can only offset up to 80% of the income. I think those are the major rules I think your investors should be familiar with.
Oh, only those. Well, those last ones are really fascinating. And so just make sure to go listen to those. The interest limitation, I guess, the amount of interest that is related to the amount of income that you're having. That's something you should look into because it could certainly apply. 179 deduction is one other thing you mentioned. Other than that, I am just really, really surprised and really, really glad we had this conversation because there's so many key takeaways. So, Sergio, before you jump off, give the listeners just an opportunity of how they can learn more about you and your firm and what you do.
Yes, absolutely. They can look me up at our website. It's Armanino LLP.com. Or if any of your investors want to call me if they have any questions, they can reach me at 213-334-7262.
Awesome. Well, Sergio, I really can't thank you enough. Thanks again, buddy.
Hunter, thank you so much for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.